The vessel broke in public. OpenAI's board fired Sam Altman, the face of the most important AI company on Earth. Within hours, Microsoft was offering jobs to OpenAI's staff. Investors were scrambling to protect billions in value, and more than 700 employees were threatening to walk. The company built to keep artificial intelligence from being controlled by a few corporations suddenly depended on one of the world's largest corporations to survive. That weekend exposed the real story of OpenAI. Not a simple march toward an IPO, but a decade of compromises that turned a safety project into a pillar of concentrated power. Then ChatGPT arrived as a research preview, and OpenAI crossed from lab to mass-market product company almost overnight. The research system began to acquire a business shell. ChatGPT Plus put a $20 a monthly subscription in front of consumers. Enterprise followed, aimed at the workplace concerns that decide whether software enters a company or stays outside it. The lab was becoming a factory. Prompts went in, software value came out, and every new customer made the machinery harder to unplug. Behind the consumer explosion, OpenAI had already built the industrial pipe, an API that let developers put its models inside products and new applications. Microsoft then licensed GPT-3 technology for its own products and services, while OpenAI kept GPT-3 available through the API. By Microsoft's own framing, its January 2023 multi-billion-dollar investment was the third phase of a long-term partnership. Microsoft also said Azure would power all OpenAI workloads as the exclusive cloud provider. The stakes were no longer confined to one San Francisco research lab. McKinsey estimated in 2023 that generative AI could add $2.6 trillion to $4.4 trillion in annual value to the global economy. When that much value appears on the table, the company producing the reference model stops being a curiosity and becomes part of the industrial base. OpenAI began as a non-profit built around one promise: artificial general intelligence should benefit all of humanity. Its charter later hardened that promise into a governance doctrine, placing OpenAI's primary fiduciary duty with humanity. The charter also warned against unsafe races to AGI and explicitly contemplated stepping aside or assisting another value-aligned project if competition would undermine safety. The original idea was not just to build intelligence, it was to prevent intelligence from becoming the private weapon of a narrow balance sheet. That is why the later transformation carries such force. OpenAI was founded as a non-profit meant to ensure that artificial general intelligence benefits all of humanity. Yet the economics of building frontier AI pushed it toward one of the largest and most consequential prospective IPOs in technology history. The founding promise was a containment vessel. Research would be governed by a mission broader than shareholders, and power would be held in trust for humanity. But a vessel is tested only when pressure rises. In AI, pressure came from compute, talent, data centers, cloud distribution, and the speed at which rivals could turn research into products. The contradiction was present from the start, but dormant. To keep advanced AI outside conventional corporate control, OpenAI would eventually need tools that only the largest corporations could provide. In March 2019, OpenAI created OpenAI LP as a non-profit controlled capped profit vehicle. The organization said the most capable AI systems required major computational power, and that OpenAI would need to invest billions of dollars in cloud compute, talent, and AI supercomputers. Its answer was a structure in which investors and employees could receive limited upside, while returns beyond the cap flowed back to the non-profit. OpenAI said first-round investors were capped at 100 times their investment, and that the non-profit board controlled the LP. On paper, it was elegant, enough upside to raise capital, enough mission control to resist ordinary shareholder primacy. In practice, it placed a commercial engine inside a mission vessel and hoped the casing would hold. At that stage, OpenAI still said its day-to-day focus remained advancing AI technology, rather than building fully formed commercial products. Even the API carried that tension. OpenAI said it would help cover costs in pursuit of the mission. GPT-3 made the pressure visible, scaling the language model arc to 175 billion parameters. The economic implication was severe. Better models required larger machines. Larger machines required deeper capital, and deeper capital required a business model that could keep promising scale. The cap that once made the structure legible became harder to square with repeated capital raises at higher valuations. Inside the lab, scale became the pressure point. GPT-3's 2020 paper pushed the model to 175 billion parameters and argued that scale improved few-shot performance. InstructGPT's 2022 paper formalized reinforcement learning from human feedback as a method for making models follow instructions more reliably. Then the machine crossed another line. The GPT-4 technical report presented it as a large multimodal model with substantial gains across professional and academic benchmarks. It was no longer just speaking. It was becoming useful enough to reorganize software budgets. OpenAI widened the stack, turning ChatGPT from a breakthrough interface into a product line. ChatGPT Enterprise arrived in August 2023. Sarah Fryer later described the next phase as one centered on agents and workflow automation that take action across tools. Capital followed the pressure curve. The capital followed. Reuters reported that OpenAI closed a $6.6 billion round in October 2024 at a $157 billion valuation. Then the numbers moved again. Reuters reported a $40 billion SoftBank-led round in March 2025, valuing OpenAI at $300 billion. By February 2026, OpenAI said it was raising $110 billion at a $730 billion pre-money valuation. The containment vessel was now being reinforced by the very giants it was once designed to counterbalance. After the November 2023 rupture, OpenAI rebuilt the boardroom around a more conventional governance posture. In March 2024, Altman rejoined the board. The company was installing public company muscles before it had a public ticker. In June 2024, OpenAI hired Sarah Fryer as CFO and Kevin Weil as CPO. Regulators saw the same concentration dynamics forming around the industry. In January 2024, the FTC launched an inquiry into generative AI investments and partnerships involving the largest technology companies and frontier AI startups. The pressure reached the governance seams. Reuters reported in July 2024 that Microsoft gave up its OpenAI board observer seat amid regulatory scrutiny. Reuters also reported that EU regulators concluded the Microsoft-OpenAI partnership would not fall under the bloc's merger rules because Microsoft did not control OpenAI, even as they sought views on exclusivity clauses. The distinction was almost cinematic. Influence everywhere, control nowhere, clean enough to name. In March 2025, Reuters reported that the UK dropped its merger-style probe after concluding Microsoft had material influence, but not de facto control. The pressure was no longer theoretical. In December 2024, Italy fined OpenAI $15 million over privacy rule breaches. The latest restructuring proposal keeps the non-profit at the top of the legal chart, but changes the machine beneath it. OpenAI has said the operating company would become a Delaware public benefit corporation with ordinary shares, a form designed to raise conventional equity while still naming a public benefit in its charter. The old capped profit bargain is being replaced by something closer to permanent capital. Investors can underwrite the furnace, employees can hold standard equity, and the non-profit remains the formal governor of a company whose assets are now industrial rather than experimental. That distinction matters. A Delaware PBC does not erase shareholder pressure. It adds a public benefit mandate to a corporate vehicle still built to issue stock, sign cloud contracts, compensate talent, and absorb capital at frontier scale. The vessel still says mission. The mechanics now speak the language of the public markets. There is no public prospectus, no ticker, no proposed offering size, and no complete set of audited financial statements available to outside investors. But the logic is already visible. A consumer product with subscription revenue, an API platform embedded in software companies, enterprise contracts sold into regulated industries, and a strategic dependence on Microsoft's Azure infrastructure. So the ending is not whether OpenAI rings a bell on an exchange. The sharper irony is that the company built to protect humanity from concentrated AI power has become one of the few institutions capable of concentrating it, reshaped by capital, chips, cloud, and customers, one breakthrough at a time. OpenAI began as a release valve, a way to keep artificial intelligence from hardening inside a few corporate walls. Its charter said the primary fiduciary duty was to humanity. Its early leaders included Ilya Sutskever as research director, Greg Brockman as CTO, and Sam Altman and Elon Musk as co-chairs. It once withheld GPT-2 weights over misuse concerns. Then the cost curve arrived. Infrastructure, customers, scarce accelerators, and capital markets waiting at the edge. The question is no longer whether OpenAI can avoid concentration of power. It is whether it can govern that power once it depends on it. The company that was never supposed to become ordinary infrastructure has become a test of what public interest means when the infrastructure is privately financed.